Well, concerns mounting in China as their economy continues to run into new issues. Following President Biden calling the economy a ticking time bomb, one of the country's largest private developers, Country Garden, hit a record low after reportedly looking to restructure its debt. It comes as another shadow banking giant raised fears after missing payments on several high-yield investment products. For more on what this means for U.S. investors, we want to welcome in David Sekera, Morningstar Chief U.S. market strategist. David, it's good to talk to you today. It does feel like those red flags that a lot of analysts had warned about before in China are continuing to pop up even further. You're talking about the real estate market, the debt that's been happening there, and then concerns around shadow banking, which I feel like we've been talking about for years. How are you looking at all those latest headlines coming out in the context of the slowdown that we've been seeing in China, or slow growth we've been seeing in China?
Well, the first thing I think you have to remember is that the direct impact to the U.S. economy from China is actually relatively limited. When you look at the amount of exports from the U.S. to China, it's still a pretty small part of our economy. So I think really the impact is going to be, mostly concentrated within a handful of companies, specifically technology companies that have a lot of restrictions in what they're allowed to be able to export, into China. A couple of companies that I'd be concerned about there would be like NVIDIA. That's a company that while it has great growth prospects, we think it's just run up too far in price. It's currently rated 2 stars. It trades at about a 40% premium to our fair value, as well as a lot of the semi-equipment suppliers. ASML would be another one where a lot of those restrictions are really going to hamper their ability to export some of their higher end. But really more important with China, I am very concerned about the weakening in consumption. I know our analysts over there have highlighted that, and as you mentioned, the real estate valuations are at risk. We actually recently cut our fair value on a Country Garden. I think it was last week. And we expect, the Chinese economy, not only is it going to slow for the second half of this year, but we think it's going to be slowing over the next several years. I know we're looking for GDP to slow down to a 3% growth rate by 2027. And of course, that can have, a negative impact on the consumption and economy. And those companies that are most tied to it would be companies like Apple, Tesla, and Nike.
Dave, does this at all change the projections here in the U.S., given some of the concerns that we're seeing globally, specific here in China? Because at least when it comes to the U.S. as of late, that soft landing has certainly been the dominant market narrative. Is that still intact?
It is. And that's been our forecast since the beginning of the year. We've always been in the no recession camp. Now, having said that, we're looking only for, 1% GDP growth here in the third quarter. And in fact, we do expect that the rate of economic growth will continue to slow sequentially for the next 3 quarters and won't bottom out until the first quarter of 2024. So again, our base case is, tight monetary policy, decreasing lending. It will all take, their toll on the economy. However, we do expect inflation will also to continue to moderate. We think it's going to drop down, should be 2% next year, in our view. So we do think that by the beginning of next year, maybe even as early as February, we expect the Fed's going to reverse course and start cutting interest rates.
What was that timeline again?
So we'd be looking for the beginning of next year, probably in February is when in 2024. So the Fed could start cutting interest rates.
Let's talk about what we got in the news we got in the steel industry today. U.S. Steel soaring on news. It rejected a $7.3 billion buyout proposal from rival Cleveland-Cliffs and is exploring strategic alternatives. We've got news now that Esmark has announced they have offered a deal to buy U.S. Steel shares. As we were saying earlier, we have seen a big run up in steel prices, partly because of the tariffs, but also because of this expansion we've seen in manufacturing coming through from the IRA. What's your outlook in the sector, and to what extent are we likely to see the ripple effects coming from this?
Well, if we're looking at M&A specifically, it has been really slow as far as mergers and acquisitions in the first half of this year, between rising interest rates, making buyouts more expensive, in the funding markets, like the levered loan market being relatively tight. We've seen M&A on the low side, but we do think it's actually poised at this point to start ramping back up. In fact, we expect the M&A will probably increase over the next, 6 to 18 months. And listening to a couple of the investment banker conference calls, I think they're calling for the second quarter to be the the low for M&A. So when I think about it from a strategic point of view, if we're right and the economy does slow the next couple of quarters, that of course then leads to slowing organic growth rate. You could see management teams, looking for acquisitions in order to bolster their own growth. But then also looking at the private equity market, PE sponsors still have over $1 trillion in dry powder that they're just itching to put to work. And if you look at, some of the valuations, I know according to PitchBook, private equity valuations are still down 20% from their highs. So I think that's all going to line up, for a good M&A in the second half of this year and into next year.
David, what does that mean for the markets more broadly speaking? How big of a catalyst is it going to be a catalyst at all?
I don't know if it's going to be much of a catalyst overall. The market is up over 17% year to date, following this strong rally. When we look at the broad market, it's only trading at about a 4% discount to our fair value. Of course, it was at a much, much lower, valuation at the beginning of this year. So I do think looking forward with the economy slowing, I expect returns to be much more muted over the remainder of this year. In fact, I think now is a really good time, especially while things are relatively slow and quiet in August. Take a fresh look at your portfolio. I think now is a good time to start selling, lock in some of those profits on stocks that have run up so much that they become overvalued, overextended. Nvidia would be one that I would highlight. Netflix, Oracle would be a couple that we think are overvalued. And I'd look to reinvest those proceeds. Look for those stocks where they're undervalued, they're unloved, they've lagged the market rally. Two I'd highlight there would be like Medtronic and Kellogg.
What are particular sectors that you think have been overlooked?
Well, the communications sector, by our numbers, is still the most undervalued sector, even though it's up, I think, about 40% year to date. It's trading at a 20% discount to a composite of our valuations in that sector. Alphabet is still rated 4 stars, even if, as much as it is, year to date, trades at a 20% discount. But we also still do see a lot of value in more of the traditional names there. Two that have certainly been in the news the past couple of weeks, AT&T and Verizon, both, have seen, kind of market sentiment turn against them with some of the lead sheathing and potential environmental liabilities. But we think the market's overestimating those liabilities. Both those stocks are rated 5 stars. They trade at a 40% discount to our fair value, and they're paying a healthy 7% dividend yield.
David, retail is going to be one of the big focuses of the market here this week. We will hear from a number of big names, Walmart, Home Depot, Target, among the companies that are set to report. What's your read right now on the strength of the consumer and whether or not that resilience narrative that we've heard in the past quarters, whether that's going to continue here this time around?
Yeah, the consumer for the past 2 years has just been under a lot of pressure with inflation well outpacing wages. That did turn the corner earlier this year. I'm just not sure if the wage increases have really gotten high enough at this point yet to really turn the corner yet. So there's 3 things I know our consumer team is going to be listening for this week. One, are we still seeing a shift in spending into grocery and away from goods? Are we still seeing consumers trade down into private label from branded label? And are people buying fewer items per trip? And if the answer to that is yes, then I do think that the consumer still is under pressure.
And with that said, any particular names that you're watching in terms of retail? We're talking about the big run-up that we've seen with Walmart, just given the value play, and now they've continued to bring newer customers into the fold.
Yeah, so one I would highlight reports end of this week is Estee Lauder, and I think that's going to give us good insight into upper-end consumers as well as the global consumer. Now, that stock ran up way too high during the pandemic in our view. It did hit a 1-star rating. It began sliding in 2022, and it's still trending down at this point. And I think a lot of that's just because of concerns on the post-pandemic recovery in China has been pretty slow. But at this point, we think that the stock is sold off too much. It's rated 5 stars, trades at a 34% discount to our fair value. And our analytical team actually recently added that to our best ideas list. I spoke with our analyst there, and she noted that the challenges here she think are cyclical and not necessarily structural. And she also highlighted for long-term investors, she thinks it has really good growth prospects. Emerging markets, I think are about 1/3 of their revenue base.
David Sekera, Morningstar Chief U.S. Market Strategist. Good to talk to you today. Appreciate the time.
Thank you.